Hey, good morning, everybody. It's Hammer. Today is Wednesday, March 26, 2025. I, of course, am Hammer with Hammer Solutions. Here's the daily mortgage rate update, the only place out there where you can hop on and chat with me about what's going on with some pricing each and every day at 9:30 a.m. Eastern Time. Broadcasting on Facebook and on YouTube. If you're here live, like James Mahan, say good morning. Good morning, Mr. Mahan. Great to see you. Cindy Pulliam, great to see you. Happy hump day, my friend. If you're watching on the replay, don't forget, give me a hashtag replay in the comments. Let me know that you were here. Don't forget to smash that like button, tag an fellow friend, share this post in a group. If you're on YouTube, go ahead and subscribe and click that thumbs up. Remember that if you'd like a reminder that I'm going live, you can get a text alert that will give you the link each and every weekday morning to hop on. It's hmmr.io/reminder. Of course, you can opt out anytime, and it doesn't cost you anything if you do want to opt in. That's right. I pay for these texts. May not sound like a lot, but there's actually quite a few people on the list, so it's a few dollars, but I don't mind doing it if it helps y'all. And we appreciate you joining me each day. You can also use this cool QR code over here if you'd like to sign up for that as well. Let's go ahead and let's say hi to all the live folks here this morning. Mr. Ron Siegel says today is National Nougat Day. National Nougat Day, not Nugget Day, not Chicken Nugget Day, Nougat Day. What kind of candy bars have nougat in them? Nougat, isn't that like that foamy, like Three Musketeers? Isn't that nougat? Doesn't that sound right? Megan Lindbergh, good morning. Rob Stewart, great to see you. Jared Vincent, good morning. Amy Blauser, great to have you here as well. Taylor Henry, Colin Jordan, Mike Morano, great to see all of you. Mallory Foti Otis, good morning. If I didn't say hello to you yet this morning, say hello so I know you're here, and I will say hello back. While y'all are doing that, let's go ahead and let's get started. We'll talk about what we got going on this morning. So let me pop up the screens. Good morning, Mr. Candido Diaz. Great to see you, sir. All right, so what do we got going on this morning? Let me see here. Quick recap, mortgage bonds basically improved a bit through the day yesterday. See down here, this chart down in the lower right corner. We start the day at 8 a.m. Eastern Time. Bonds are lower. They kind of improve as pricing's coming out around 10 a.m. That's generally when you see most lenders do rate sheets. 101.30-ish is kind of where they're at. They creep up a little bit lunchtime. They pick up 10 or 12 basis points. There were just a couple, a handful of lenders that repriced better. Just the ones that like to really play it tight and fast, UWM, Provident, some of those. But otherwise, it was generally a really quiet day. Bonds lost that ground, though, through the afternoon and basically ended the day, not unchanged overall, but unchanged from when pricing came out. So pricing came out, around 101.30, and they were right around 101.34. So it's almost exactly the same as when pricing came out yesterday. Today, you should see rate sheets that are similar to yesterday's. Again, right around that 101.30 mark right now. Mortgage-backed securities 101.27. If you take a look here, you'll see we see some volatility this morning. Bonds drop down, they pop up, they drop down. Basically, not a lot of real movement, but just some volatility. When you look at the 5.5 coupon, you're not seeing that. So that shows me it might be more of a volume thing where we're seeing some erratic trading with the volume thing. And it's one of the reasons why Mortgage News Daily and Matt Graham, he's following that 5.5 coupon. He's got the little happy star there that is the most relevant coupon to follow. And again, it doesn't really matter. You can see the same behavior with that one yesterday. It was 99.58.59 when pricing came out, and it ended the day around 99.59. So you see that same behavior overall, but this morning we see a bit of a difference, and that's worth paying attention to. There's a little more volatility this morning in that 6.0. If we get rid of some of that chatter, bonds are down on the day. And what that means is that rate sheets will be similar or a little bit worse than what they were. They were like 99.58-ish as rate sheets were coming out yesterday, and we're down about 10 basis points from there. So reprice risk on the day is low. As far as what's going on this morning, we had a couple of Fed speakers during the day. We've got the 5-year Treasury auction this afternoon. Nothing's going to cause any big moves or anything we have to worry about. So what else is affecting rates this week? Again, more tariff talk. That's just a continued thing. Now they're talking about copper tariffs, and copper tariffs are important because remember that's on a lot of different things. It is on electrical wire and electronics, and copper is one of the bigger metals that we use, even more so than steel, I believe. So that's a big deal. Recovery in stocks continues to be, playing a role this week. And then tomorrow we're going to get the GDP data, but that's really not going to be a big deal. But we're going to get the PC inflation data on Friday. And even that, you're not going to see any huge moves, but you will see things move a little bit. So good morning, Angela Walters, Mike Morano, Tanya Wermond, Allison Foy, Brenda Jenkins, Dan Herbert, and Jordan Ross. Great to have you all here. So I wanted to show you guys this chart here and kind of go a little bit deeper on some things. So let's look at a few things. So number one, remember when things go up, that's better for your pricing. It's better for rate sheets. Rates are improving. When mortgage-backed securities sell for more, it's kind of like you're using an increase in rebate pricing on your rate sheet. And then when it goes down and they sell for less, you see a decrease in rate sheet pricing. So again, this is not fully how it works. It's tremendously oversimplified, but pretend you were getting a rate of 6.0, which is what this coupon is. At a 6.0 rate, you'd be getting a rebate here at 102.55, and down here you'd be at 99.60. So you'd have to collect a premium. You'd have to charge points to give 6% at this rate, right, at this pricing. But over here, you'd be getting a rebate of 2.5 points. So that's how these work. Again, oversimplifying the rate end of it, but basically that's very much how the behavior goes. Now, here in September last year, we had basically our best pricing. Rates had fallen into the low sixes, and we thought we were going to see some continued improvement, maybe even touch the high fives for conventional. By the time in September here, the Govy stuff was actually in the high fives while conventional was in the low sixes. And then we basically saw a large shift in opinion of the election and all of the different political races. And we saw what was called the Trump trade, and bonds lost ground on the expectation that we would see a thriving economy, that we would see uncertainty in tariffs and things like that. And by the time we got through, it looked like we were going to get a break here at the beginning of October. And if you notice those levels, very much right around the same levels as where we touched here in March. So these, we were back here, we were around 101.60, right, for a level. And then take a look here. We're at that same thing. Do you see that? Look at this dotted line that's here, and you'll see that this was a level that held up for a week, and then we saw another dip. We saw some recovery. We could go back and probably find that was tied to some economic data, whether it was jobs data or let's see, what date was this? So that would be jobs data that was here. And then we saw some losses again, but then we saw some more recovery. And as we came up through December, things started to recover. Then January, you'll remember, as we came up through, actually at the beginning of December, it was great. Through December, we lost ground. January, we lost more ground. January 13th, the worst level that we saw going all the way back to May of last year, is right here. I mean, that's how far back it was. And then since then, we've seen mortgage-backed securities improving, a little bit of a sell here, then they improve, and you see the ebb and the flow, but really continuing up, an overall trend from January 13th until the beginning of March, right? The first couple of days of March. Then it gets rocky, and we start to level off, then we lose ground. Last week, we got a bit of recovery with the Fed meeting. If you remember, this was the Fed meeting that gave us this recovery here. And then now we've kind of come back down, and we're testing these same lows again. But there's really no reason to expect that mortgage bonds are going to stay at this level. When we can see that mortgage-backed securities could fall down to the purple line here, that's the 200-day moving average. So we could see mortgage-backed securities fall down to this purple line. It's at 101.13 right now. We are at 101.24. So that's another 11 basis points. And you see the same thing here with the 10-year Treasury yield. We've seen it go up to 4.34. Now it's at 4.35. We've got a convergence of the green and red lines here. That is the 1,500-day moving average at 4.42, basically 4.42, 4.43. And that's probably where we will see this 10-year Treasury pressure. Now, this does not bode well for rates and pricing, is the bottom line. There's really no reason to expect things are going to improve from here. Friday, we get PCE inflation data. It's likely to show inflation was slightly better than expected. Part of that was based on some of the data you could pull out from the wholesale inflation from the PPI, Producer Price Index. Part of it's just because of what speculation is, but it's not going to be any holy savior this week on rates. We've really seen this. Let me pop this chart back on. We've really seen bonds lose ground again here, and I think we're going to continue to see them lose some ground, and that's it's a concern. So my advice is to go ahead and lock anything that's closing near term. I would also consider locking anything closing in the next 30 days. Here's the caveat: if next week's labor market data does show significant weakness, we could get a bit of a rally. Not going to be a long rally, not going to be a big rally, but we could see rates improve a little bit heading into next week. It could bring us back from some of these levels. The problem is, as we get there, we're seeing rates creep worse and worse. You're seeing rate sheets creep worse and worse. So you can see that we were back up at 6.80 a couple weeks ago, middle of March. We're just coming up on the end of March now, right? 6.80, 6.81. We got a little bit better again after that Fed meeting here, and then now it's back up. And we could actually see, we've seen rates hold. Look at this, the 6.7 to 6.8 range, that eighth of a point range has been dominant for over a month. And we're in danger now of seeing that get broken. We could see mortgage-backed securities. We could see them drop further below here and see rate sheets continue to creep worse. So, although I say to cautiously float anything that's 15 to 30 days, I'd consider locking it. I really would, because the question is how much worse can things get in the next 10 days before we get to the BLS jobs data on Friday, and are we going to want to float into that jobs data? If that jobs data were to surprisingly show some strength, that would be ugly. It would definitely cause bonds to lose ground. We'd see rate sheets jump on that. Jump meaning get worse. Rates would jump a little bit. So we got to kind of factor that in. It's not a big risk, but it is a risk. It is possible. So good morning, Bill Stevens, Tim Klyla, Julie Lawrence. Great to see you all here. So anyway, looking at this, I know everybody wants to see rates continue to improve. The reality is these are kind of where rates are at. That's actually good news, because we're not seeing rates worsen with this talk of tariffs and everything else. But there's not much else that's going on here. You see fatigue with markets with all of this movement and kind of where things are at. As we take a look here, there's no clear cut argument that rates are going to get significantly better or significantly worse. I think we continue to see them creep a little bit worse from here, though, is my take on it for now. We could see some support here at like 101.19. That was what we had here back at March 14th. That could be a line in the sand. And again, when we look here at the 200-day moving average, hold on, I got to refresh this, so let me scroll it. There it goes. That's at 101.13. So, and that's slowly creeping up every day. It creeps up a basis point or so every couple of days. So that 101.19-ish is going to be the line in the sand in a few days as well. But morning, Nathan Einkorn, Christy Rezor. Great to see you as well. So anyway, keep an eye on this 10-year Treasury yield. 4.34 is a technical. I haven't really talked much about it. I think it's one of the Fibonacci levels, but I'm more concerned with the convergence of the 100 and 200-day moving averages I'm sorry, 150-day moving average is around 4.43 up here that we could see, and you could see that 10-year Treasury yield jump those 8 basis points to get there. But other than that, there's really, again, Friday we get PC inflation data. I don't think it's going to be any great market mover. It's not going to be our grand savior. It's next week labor market data that really has to come in showing labor market weakness, and that could give us a little bit of a recovery rally here, and bonds could kind of lift up, but it's not going to be much, and they're not going to improve better. That's why I did move into a locking stance late last week after the Fed meeting, and because I felt like we were going to cap out there, and that's been the case. And again, I'm not right all the time. I'm not even right probably half the time, but that one was kind of just was pretty obvious, and it looked like we'd really have to see some help to improve. The question now is how much worse will bonds continue to trickle? And that's the general direction, and market sentiment not in our favor right now. You look at this, they're trickling down. So that puts me in more of a locking bias. I'm kind of holding on to that cautiously floating for loans that are closing in April, but I wouldn't, if the consumer likes the pricing, lock it. The only problem is when you're locking loans that don't close for 3 or 4 weeks, if the labor market data does come in weak and rates start to improve, then you're going to have to kind of backpedal on that. And that could be a little bit of a concern. So if it's that kind of squirmy consumer, keep that in mind. But for people that are loyal and Nathan says, I hope you're wrong. I hope I'm wrong too. Again, if labor market data shows a lot of weakness next week, then we could see a bit of a rally, but rates aren't really in a position to move significantly lower until we see some very clear signs that the economy is in distress. Now, there's a lot of talking about yesterday's consumer confidence numbers, and it was the worst number in 12 years. And, consumer confidence it's overrated because people are still spending money. They're not confident. They think it's going to be bad, and yet they still borrow. They still put things on their credit card. They still go out and buy things. So, because when you look at that piece, it doesn't really coordinate. It doesn't support the story. So, otherwise, looking through all this other stuff, there's really not anything there that I think is really all that relevant to what we'd be talking about. Again, more of the tariff talk and copper, car prices could go up. These are things that could push the economy to take a bit of a bath. And if that happens, then you'll see rates improve a little bit. But in the meantime, looking at what markets are pricing in, they don't expect a cut in May. There is expectations of a cut in June, though. It's basically 2/3 right now. A very small portion believe we would see a bigger cut. But the reality is that June is when markets believe we're going to see at least one cut. By the end of the year, though, basically pricing in 2 quarter-point rate cuts with kind of a coin flip for possibility of 3. 2 is winning. We've seen 3 winning in the past. 2 is winning. If we see this side of that column really drop, then you'll see rates worsen. If we see this side of the column really drop and this goes up, then you'll see rates improve a little bit. Right now, though, not really happening. So that's what we got, my friends. So with all that said, if you would like an email to your inbox each and every weekday morning of what it is that I do, let me show you what that looks like since we can, right? Why not? There it is, market commentary. Here you go. Come on. Oh, it won't open because I always wonder how you can't just pull that out separately. Let me see here. Show my screen again. There you go. And side to side. Okay, so taking a look here, if you would like an email to your inbox each and every weekday morning, you can go ahead and sign up at www.ratelockadvice.com. Feel free to take this info, use it any way you want. I know in the past, Ron Siegel's taken it, fed it to ChatGPT, and used it to share it. If it helps you with your business, share it any way you want, my friends. I'm definitely here for that. Also, consider signing up for our text lock advice. We have text alerts. They're $7 a month. You get a morning alert, you get an afternoon alert. And anytime that we have a lot of risk of repricing, either better or worse, we'll send you a text and let you know and warn you. You don't have to spend a lot of money to have a live service to keep you abreast of it. If you're not big on the charts and the graphs and all those things, you don't need to be. You can just sign up for our text alerts. real life, easy to understand. We have, I think, 1,150 something members in there, and they're great. $7, you can't beat them. All right, and last but not least, if you'd like to go check out Originator Success, check us out at originatorssuccess.com. Also, if you go to grabandgosocial.com, you can take a look at Grab and Go Social. We have reopened up the pre-sale for now, so you can get in for $7 a month. We're doing a lot of work on it, so I'm still not happy with where it's at. Ron Siegel, you've seen that, but we do have the dashboard live, and we're making some furious edits to have that ready in the next couple of weeks to really fill that thing up and have tutorials and all that. So Austin's been working on a lot of that. We just got to get it in there now. So if you'd like to get in on the pre-sale before we launch this live at full price, feel free to jump in and go check that out as well. So, all right, my friends, so that's it. I hope you all are having a great day. I don't have a question of the day for you. Unless anybody wanted to take a thing and let me know about Nougat. Mike Morano, all calls are recorded for Grab and Go Social. You can find them in the Facebook group and also the dashboard. If you're Mike, forgive me, I don't want to offend you, but I don't remember if you are an Originator Success member at the moment or not. If you log into your Originator Success dashboard, you'll see a section now that you can log into Grab and Go Social, and that replay will be up there today. I think last week's replay is there right now, but this week's will be up there today. He'll upload it. And then the replays, they should be available in the Facebook group, and he just has to have them render, and then he puts them in. So they'll be up there today in the Facebook group, and you guys should have access in the dashboard. If you're not an Originator Success member, by the way, you can log in, and you'll just log in directly to the Grab and Go Social dashboard. So, all right, my friends, that's it for us, and thank you for joining me. I'll see you guys tomorrow. Bye-bye.